Hello and welcome to this Fund in Focus, brought to you by Livewire Markets. My name's Eddie Orchard, and today I'm sat down with David Wimborne from Impax Asset Management to discuss the ins and outs of the Impax Global Opportunities Fund. David, thanks so much for joining us here today.
Thanks very much for having me.
Sustainable investing is not a new theme in markets. Why is now the right time for investors to be allocating to this space?
Yeah, absolutely. I think it's very fair to say it's not a new theme within the markets. And maybe to that point, for a bit of history on Impax, we were founded in 1998, and we've had a sole focus on investing in opportunities in this transition to a more sustainable global economy. So we've been at it for 26 years now. So definitely not a new area. But what I think is really interesting is that if I was to characterize this opportunity set and how it's evolved over those 26 years, I would say it's broadened out immensely. I'd say it's much, much broader than many people expect. And the drivers behind these opportunities are very, very long duration. You know, these are problems that we've got to fix over 5, 10 years and beyond. So that's why I think we find it such an attractive opportunity.
And how is your approach different from other peers in the market?
Yeah, I'd say probably the main thing there is really our heritage and provenance in this space, and maybe it comes down to the experience. Maybe for a bit on that is that Impax actually developed the first environmental markets taxonomy, which essentially means way to categorize opportunities within that opportunity as early as sort of the mid 2000s. So I think kind of that the fact that we've looked at this space for a long period of time, I think we've seen sort of the highs and lows of sustainable investment over those 25 years, and hopefully that gives us a nice edge in terms of our investment expertise. And then I guess maybe on the global opportunity side of things, I think it's the fact that we've had this strategy. We seeded it in January 2015, so it's been running for 10 years now. And I'd say kind of this was really an early pioneer, I would say, in kind of this interest in sustainable investment. It really sustainable investment as a theme really took off in the late 2010s. Impax has always been there, and kind of global opportunities really caught the imagination of investors who wanted to invest in sustainable opportunities, but across that environmental and social side of the equation.
I know you dived into a bit of the heritage before, but can you take me maybe a bit more inside the team at Impax and why they're so specialised in what they do?
I guess for a bit of history, I joined Impax in 2015 to really establish the global opportunities strategy. And when I joined, we were a very small organisation. We were quite niche. I think the entire investment team was about 15 people. It's now 55, and so over that time, we've kind of we've been very fortunate to have a nice growth in our assets under management. And I think coming back to that provenance point, I think people were interested in sustainability and they wanted to, look at sustainability with someone they felt was authentic in this space. And I think that's what helped with Impax. In terms of the team behind it, so I co-manage global opportunities with my colleague Kirstine Morrison. We've worked together now for the best part of 10 years on this strategy as co-PMs. But we're supported by a very, very broad team. Across the team, I think we have maybe 35 individuals who are analysts across this whole environmental and social sustainability opportunity set. So I think the most important development of the team over the last 10 years has been just a massive increase in depth and breadth of that team. And I think maybe another thing which is characterizing Impax over that time is basically just the consistency of the platform as well. So Impax was founded by a chap called Simm in 1998. He's still our CEO to this day. And employee number 2 was a chap called Jenkyn-Jones, who's still CIO. And I think kind of those long tenured focus on these areas, I think again, has been another thing which has sort of really been supportive to our growth.
Yeah, amazing. We'll get into some of the opportunities in a sec, but before we do so, it's always nice to cover off some of the risks. What do you see as being one of the prospective risks that investors should be aware of heading into this space?
Yeah, so I think you need to understand that even though we believe there are sort of wonderful secular drivers pushing forward, demand and hopefully share price performance over the longer term in this space, there will be times when these themes will be out of favour, and we're always very, very clear to investors that sometimes there will be market environments where these funds won't be so appreciated. So, and I guess more broadly, just thinking about market dynamics over the last 18 months or so, of course we've had a very unusual period of market leadership over the last few years. 2022 was all about energy because of the Ukraine war situation, and then 2023 was dominated by AI. Now we know in 2022 that dominance by energy also is going to be a bit of a headwind for sustainable investment. Very interestingly, if you look at the performance of global opportunities in 2022, we performed in line with the benchmark that year, which I think was a much nicer experience for investors than many sustainable focused investment funds. 2023 was of course a challenge because, as we're all probably had enough of talking about. It's the dominance or performance by that Magnificent Seven tech companies, where we have an underexposure, was obviously a bit of a headwind. But what we've noticed is that any time there is a broadening of market leadership away from those 5 or 6 companies, we tend to get a nice resurgence in performance.
The Global Opportunities Fund invests in 35 to 45 names, very high conviction strategy. How do you go from breaking down that addressable universe of a few thousand companies into those 35 to 45 names?
Yeah, absolutely. So you're absolutely right. A concentrated high conviction portfolio. In terms of how we go about screening this sort of vast investment universe, I think this is an important difference, in evolution of the firm from, when we started environmental markets onto, the broader global opportunities. The environmental market side of our business, screening the investment universe in some ways is quite simple because we have a revenue threshold. In other words, for companies to qualify for our investment universe, they need to have, at least 20%, typically 20% exposure to these environmental markets trends. Now, global opportunities, because it has a broader remit and invests across all of those other sectors, I mentioned healthcare, financial services, we realized the revenue stream wasn't really feasible because, there's 7,500 companies out there with a market cap above 1 billion. We'll be, spending all year, going through those companies. So instead, what we did is we developed a proprietary tool called the Impact Sustainability Lens. And what this lens does is it aims to identify attractive subsectors within the market, to really focus our investment energies on. And what I mean by subsectors is if you think how the markets are organized, you basically have about 11 super sectors within the market, things like consumer staples, consumer discretionary, healthcare, utilities, industrials. If you go down to the most granular level of analysis called GICS level 4, there's actually 160 of those. And we go through each of those 160 to try to understand the balance of opportunities and risks in each of those different subsectors. And not surprisingly, some of those subsectors we believe have a much better balance of opportunities and risks, and we try to focus our energies on those, whereas others will have loads more risks that we're trying to avoid and less of the opportunities. So it's really about prioritizing more attractive parts of the market. It doesn't give you all the answers, but hopefully those are attractive pools in which to fish.
Speaking of the opportunity side, can you take us through maybe an example in the portfolio that illustrates one of those high quality, high conviction opportunities you're seeing at the moment?
For me, one of the most remarkable shifts we've seen over the last few years has been the whole shift to reshoring and nearshoring of manufacturing capacity. So we've seen this huge increase in manufacturing activity in the US after arguably 20 years of underinvestment in the manufacturing base. Now, what would be companies that would benefit from that? Well, for me, one of the key beneficiaries of that uptick in spending is actually a group of companies called the industrial rental equipment companies. So one of the companies we hold in the portfolio called Ashtead, which is actually a British company, but the majority of their business is in the US. The most amazing thing is that I spoke to the CEO of this company. He said that when one of these big projects is going in the US, this company Ashtead will have something like $200 to $300 million worth of their plant on site, enabling it to take place. Now, when you think about it, there's very, very few companies out there that can provide that much equipment on such short notice. There's 2 of them, really. Ashtead and United Rentals, they're the 2 big companies in the US. So you see pragmatically a really interesting opportunity in terms of capturing this nearshoring of demand. But really importantly, from a sustainability perspective, industrial rental equipment companies are a really good example about how circular economy business models are now penetrating industrial end markets. We're all very aware of the rise of the sharing economy in the consumer space with Uber and Airbnb. Well, exactly the same thing is happening in industrial end markets. The economic rationale makes sense because you don't have to buy a piece of machinery, but of course the sustainability rationale is you have much higher asset utilization on a fixed base. Not all these companies need to buy their own equipment anymore. You just basically use what you've got more effectively for project A, project B, project C, or whatever it might be. So you save a huge amount of resources as you move to a sharing economy model as opposed to only an ownership model. So we think these companies, are well positioned for that big, secular drive, which I think will continue under a Trump presidency, as well as ticking the box in terms of sustainability. So I think a lot to admire about that sector at the moment.
Yeah, incredible. And on the flip side as well, I always like with high conviction managers asking what's a position that you've sold out of recently? What was the change in the thesis? What made you kind of want to sell out of that? So can you take us through maybe a company that you've recently sold out of?
Yeah, no, absolutely. So, and it's a good example because unfortunately investments don't sometimes work, and this is one that didn't work for us. It's a company called MSCI. What MSCI do is they provide index data provision. So when you see the global funds out there, they're normally benchmarked against a fund called the MSCI ACWI Index, All Countries World Index. And this company essentially makes about 75% of its revenue from index service provision. And for us, this is a really interesting business because essentially if you're a fund manager, the very last thing you're going to turn off is your index provision service. It's basically like you've held the white flag up that you can't compete anymore. So their core business is incredibly strong. Now the issue here is that about 10% of their revenue comes from basically ESG data analytics. And even though their core business is absolutely the driver of the company's revenue and margins and returns, sentiment-wise, it really gets impacted by that small section. We sold out of the company earlier this year, slightly opportunistically actually, because you might remember earlier this year there was the Democratic Convention, and after that there was the Kamala bounce where people were a bit more enthused about it, and that was the final thing for me where I could see that the share price of this company was incredibly correlated to the fortunes or otherwise of the Democratic Party. And so we actually took the opportunity, to exit that position on the back of that. Now, pleasingly, that's been the right decision to do because, as I say, the core business incredibly robust. Since Trump's been elected, it has been used as that proxy to express those concerns. So we exited that position as a result, which has been the right thing to do.
And David, finally, where can people find some more information about actually accessing the fund?
Yep, so if investors are interested in finding more information, Impax actually partners with Fidante down here. They're sort of our partner for fund distribution. We've got a very good relationship with them, so please do contact Fidante if you want to have more information.
Fantastic. Thank you very much for your time today.
Thank you.
And if you enjoyed that, feel free to give it a like and head to our YouTube channel where we're adding fresh content every week.